Hi everyone. The month of July was very interesting for emerging markets despite summertime. With global rates sticking to low levels and central banks' intervention going to uneven path around our coverage, we can state that emerging markets are not well equipped to compete with developed markets for funding, and we see upcoming difficulties to implement their fiscal plans while trying to contain their funding costs. We're still constructive on emerging market economies despite the shrinking current account, adding to the difficulties for funding, of course. We then define two categories. The first, the countries which may continue to see their terms of trade improving in 2021, the commodity exporters, which are clearly less vulnerable, hence our constructive view in MENA and LATAM. And the second category, which are the countries which are importers and are slower to reduce their fiscal deficit, which could face, in fact, more headwinds. Despite our preference for CEMEA credits over Latin America sovereign issuers, we are now gradually reconsidering this view. The key drivers of this reassessment have been worse fiscal situation, higher supply, and more challenged COVID-19 dynamics. We are now at a stage where we consider adding back risk to underperformance like El Salvador or Colombia, which have been among the key underperformers in the sector, while Argentina and Ecuador and Costa Rica have been outperforming, leaving also Mexico as the best outperforming investment-grade credit. In Asia, China's recent successive regulatory crackdown dominated the debate in the recent weeks, weakening some of the most strategic sectors for the country while testing investor sentiment and appetite. We still like Asia and approach it though on a case-by-case basis given the different domestic dynamics of the countries, and we remain cognizant of the Chinese spillover effect. The uneven recovery over there is in full swing, and we remain market weight with a cautious duration approach. Finally, in Turkey, despite an improvement in fiscal balance with a strong COVID-induced policy response combined with a strong tax collection, Turkey seems to be in the right direction, finally, but a steady structural reform program, a prudent monetary policy, and an ambitious fiscal consolidation were the key recovery drivers. I now hand over to Tanya, who will develop certain points on Middle East and Africa region.
In line with the view that commodity exporters are better prepared to ward off the upcoming volatility, we continue to favor oil-related high-yield credits in the GCC sovereigns and Sub-Saharan Africa. In Sub-Saharan Africa, we prefer Angola, given catalysts, namely the recently approved fifth review of the IMF Extended Fund Facility, which allows the immediate disbursement of the $772 million, and the lower foreign currency debt service on the recent Chinese debt reprofiling. In the GCC investment grade space, we prefer Saudi Arabia, as we are now expecting stronger GDP growth in 2021, supported by higher oil prices, increased production quotas, and higher VAT collection. In the GCC high yield space, we prefer Egypt over Oman and Bahrain because we feel Egypt's reform commitment, fiscal discipline, and the strong multilateral backing that it has within the region are key sources of credit support, which in our view help to mitigate its large external financing requirements. Recent underperformance in the market additionally makes Egypt attractive compared to Oman and Bahrain. Moving over to the Asian high yield space, we continue to favor Pakistan as we feel the IMF program delays are priced in at current levels. While the dialogue remains open and ongoing, at this time, a convergence to the IMF conditions before the September review is vital in our view in accessing the $3 billion worth of IMF financing for the year 2022. To summarize, the biggest risk we feel to our outlook is the spread of the new variant, which we feel could encumber the pickup in the economic recovery. However, we remain positive that for the second half of the year, given a targeted vaccination at an accelerated pace will help curtail the healthcare consequences of this wave, combined with obviously the ongoing support that we have seen from the central banks and the governments in terms of the monetary and fiscal policy in these emerging markets.
Thank you, Tanya, for all this explanation. I turn now to Devier. Hi, Devier. How is equity doing?
Hi, everyone. There have been a lot of concerns around peak economic and earnings growth and peak policy support thereby questioning further upside potential in developed market equities post a considerable run-up year-to-date. Given a strong consumer buoyed by significant savings and policy support remaining ample, we expect the DM economies to grow above trend in second half 2021 and full year 2022. Therefore, we continue to see a bullish case for DM equities. In context of current 10-year yields, we do not see equities as expensive as risk premiums are above the historical levels. Hence, we expect equities to grind higher, albeit with higher volatility on concerns linked to Delta variant and inflation. To reduce volatility, we recommend a well-diversified portfolio with exposure to names with strong balance sheets. We believe the sell-off from a peak of June 5th in value and cyclical sectors such as banks, industrials, energy and materials has exposed a significant value in high-quality names in such sectors in DMs. We will not rule out delays in full reopening and slowdown in leisure and hospitality sectors. However, vaccines have proven quite effective in reducing hospitalizations and fatalities. We are neutral on US and keep our overweight on Europe given its valuation discount versus US and vaccination rates expected to reach 70% of the population by September. We maintain our neutral stance on EMs given our near-term view of stronger dollar and low vaccination rates. In EM Asia, we like an exposure to South Korea, Taiwan and India. In EM MENA, we favor Saudi Arabia, UAE and Qatar, and Mexico and Brazil and LATAM. Strong year-on-year rise in commodity prices should underpin Brazil and Mexico equities and FX. In the region, we maintain our liking for exposure to countries with strong spending capacity in the backdrop of high oil price environment, along with our preference for the value and cyclical stocks in banks, construction materials, and industrials. We also prefer bottom-up plays in sectors such as retail, food and beverage, and information technology. In light of near-term concerns linked to Delta variant, we have reduced our exposure to the reopening plays. Given the strong set of results posted by the banks and management's guidance for lower cost of risk in second half on a continued macroeconomic recovery, we have increased our exposure to Emirates NBD, DIB and ADCB. We have initiated a position in Al Muammar Information System. The company is expected to be a key player in fulfilling Saudi government's vision to increase its data center capacity from 60 megawatt to 360 megawatt in next 5 years. Recently, the company has entered an agreement with Saudi Fransi Capital to establish a $320 million fund to develop, own and operate data centers with an expected capacity of 24 megawatt.
Thank you, Devier. Thank you, Tanya. Thank you, everybody, for taking the time to listening to us. You can contact us through our website or social platforms, and we definitely look forward to talk to you again during our next edition. Thank you.